So welcome everybody. This is incredible to see such an attendance. We're here to listen to the president of KAIROS Home Loan share with us what's going on in the market today in regards to real estate. So I'm going to just take a moment right now and just introduce you and tell you why we're doing this. We're getting a lot of questions from potential buyers and sellers out there on if it's a good time to buy, if it's not a good time to buy, what's going on with the market conditions, and any forecasting that we can add to it. So we've enlisted Richard Murphy, who's the president of KAIROS Home Loans, to help us and help our clients navigate through that. So Richard, take it away.
How's it going, everybody? I'm happy to help. There's a lot of bad information out there, and the bad information typically comes from one of two groups of people. The people who don't know what they're talking about, so they talk just for the sake of talking, and then people who can't do programs anymore, so they want everybody to believe that nobody can get that deal done. So we're going to debunk some myths and give some real practical application for people who are looking to buy and people who are looking to sell. I'm happy to be here.
Great, thank you. So we have a list of questions we're going to ask, and there'll be some more questions that'll come up in the chat that we'll share with you.
Okay.
But right now, we'd just like to know, what is your opinion of the current market conditions?
Suicidal if you don't know what you're doing. And that is where a lot of loan people are. They have no idea why rates are where they are. They think 3.5 is high, which is boggling to me. Information goes in and out, and the last person to get the information is the consumer, unfortunately. So also unfortunately is that there are a lot of people in the mortgage industry who don't know what they're doing, what they're talking about. They think that the Fed overnight rate is a specific number. It's not, it's a range. And they think when the Fed dropped the rate that meant the mortgage rates went down by 1%. Not even close to being true. So they spread that information. Then the borrower gets on the phone and says, well, should my interest rate be 2? Or 0? No, it shouldn't be. And then thankfully, when we explain that stuff to the borrower, then they are brought back into reality and they're good to go. Happened twice this week, 3 times this week.
Can you elaborate a little bit more or drill down? When we say market conditions, can you go in particular about California? Because I know you've had people that'll come to you, well, I've seen this interest rate, and when you dig into it, you discover it's for a completely different state. Can you explain that? Because we are dealing with people that, in California.
Sure. So there are variables. No two deals are exactly alike. So people who work together, they're both buying homes at the same time. And hey, my buddy at work got a 3.5, so why am I not getting a 3.5? Well, your buddy has good credit, you don't. Your buddy's putting 20% down, you don't. Things like that. So it leads to a bunch of confusion. It matters. The FICO score, for instance, matters on a conventional loan way more than an FHA or a VA loan, or even USDA. So the government loans, FHA, VA, and USDA, those guidelines are different than a conventional loan. That's one factor. Another factor would be, what's the loan amount? Not the sales price. Here's what I mean. It could be a $1 million sales price. But if somebody's putting $500,000 down payment, the loan amount is under 510. 510,000 and some change is the conforming loan limit. If it's between 510 and 765, 600 in LA and Orange County, that's a super conforming or high balance loan. Conversation I had with a client this week, the rate was 3.75. That's a smoking rate for a $765,000 loan. And that person said to me, well, that's about 0.25% too high. It should be lower. And I said, let's talk about that. Your loan is not a conforming loan amount. It's not 510 or lower. It's between 510 and 765. So you're about 0.25 point higher, which is still a very good rate of 3.75, considering I'm about to give you $765,000 over 30 years to pay back. So having that information and being able to explain it, he got it right away and said, oh, okay, he didn't know the difference. And that's basic. but there's a lot of information that people don't understand. So it's, I'm a mortgage geek is what I am. And so I like explaining this stuff to borrowers, agents, anybody I can help. I'm here to help.
You mentioned that you're a mortgage geek.
Mm-hmm.
Can you elaborate on your history and why you have a different grasp on what's going on in the market?
Sure. I started in 1998. I've been a loan officer, a branch manager, a production vice president. I took a small Southern California company and grew it from 7 branches to 7 states. I was the senior vice president of a major billion-dollar, multi-billion-dollar mortgage company. I've had national sales teams twice. I have been the president of a company and dealt with Freddie Mac and HUD on a national basis for the disposition of their assets and notes, respectively, meaning I helped Freddie sell their houses and HUD get rid of their pools of notes. So I had to know a little bit more than rate and payment like a loan officer, because I was dealing with people who were, quite frankly, smarter than I was. I hate losing. And so if I don't know something, then I set out to learn it. So I've spent the last 15 years looking at mortgage-backed securities and the 10-year treasury and how the 2-year and the 10-year tie into each other and how all of this is affected, if it's affected by the Fed rate. I post a commentary every day on Facebook and LinkedIn as free information. My thing is not fame. I don't care if you know my name. I don't care. I don't charge people like others do for this service. That's not my thing. My thing is to educate people, because I learned a long time ago that the average loan officer doesn't do very much business and really doesn't know what they're doing or talking about. So I wanted to be able to take 30,000 feet viewpoints and bring it down to boots on the ground, not only for the loan officer, but for the people who are buying or selling houses, so that they weren't victims of bad information, but that they could be given information, real information that they can understand so that they can make a decision. They don't follow the markets. It's not their job. So don't ask me to fix breaks. Don't ask me to sell software. But if it's mortgage stuff, I know exactly what I'm talking about.
Great. So you alluded to it, boots on the ground, what buyers and sellers need to know. Can you tell us what you think buyers need to know right now based on the current conditions?
Sure. Buyers need to know that there are 3 basic categories of lenders. There are brokers, who are in all sorts of trouble these days. They're the ones who don't have a lot of programs anymore because the companies that they were sending their business to are in big trouble. Quicken is one of them, and United Wholesale. These are 2 of the biggest companies in the country, and they're having problems. So that means brokers are having problems. That doesn't mean that I'm having problems. That means the broker's having problems. Then you have FDIC banks, Bank of America, Chase, etc., Wells Fargo. I've worked at Wells Fargo. I started at Wells Fargo. I swore I would never work at a company like that again. But when the market went kablooey in 2007, I went to Bank of America for 42 days, the longest 42 days of my life. And oh yeah, that's why I don't ever want to work for one of these companies again. Then the third category is a correspondent direct lender. That's what KAIROS is. We use our own credit card, so to speak, our own warehouse lines to fund loans, and then I sell the loan to an investor. That means that I have to take care of the underwriting and responsibility up front, because if I don't do that up front, I'm not going to be able to sell the loan, which means I would run up my credit card, very soon have no more credit, and not be able to do any more business. So we sell our loans. We do service some. Out of the thousands of mortgage companies in the country, there are 400 with Ginnie Mae tickets. What's a Ginnie Mae ticket? That means that if I do an FHA fund, an FHA loan, that means I can stick it in my portfolio and service it, or in other words, receive the payments. Only 400. Of those 400, we were all invited to go back to DC a couple of months back and meet with Ginnie Mae, who is a very small entity. If there are 150 people who work there, I'll eat my shoe. It's not a great big corporate place. It's corporate, but there are not tons and tons of people who work there. So the people with Ginnie Mae tickets, one are very few and far between. We're one of 400. Of the 400, one showed up a couple of months ago because people are scared and wearing masks and gloves everywhere and afraid to touch anything but an elbow. We showed up. And as a result of that, Ginnie Mae gave us favors that and nobody else in the whole country got. So we can do stuff that other companies can't do because we actually showed up for the meeting. We did a crazy thing and jumped on an airplane and shook people's hands. Don't tell anybody.
Awesome. From a
Hey, I'm sorry, Christy. Richard, so I just want to make sure I understand what you are saying here. So you are mentioning about the mortgage brokers. Can you repeat it one more time? Because from my perspective, okay, so you're mentioning about the reason the mortgage broker is in trouble now is because of what? Because I heard one of the mortgage broker told me that they are not doing there is no such thing as FHA loans anymore, for example, right?
That's my point exactly. That means they can't do it. So if I'm a broker, I don't have a warehouse line. I take a loan file, I shop it around. I'm not in control of the loan file, which is a problem for the borrower, but they have no idea because the broker didn't tell them. So I take a loan, I try to match it up with, I'll just say Quicken. I'll use them as an example. Biggest lender in the country, not this past Monday, but a week ago, Monday, their servicing portfolio was downgraded drastically. So that put Quicken in big liquidity issues. There are four main things that are hampering well, now there's a new one with forbearances, but liquidity, what does that mean? When this whole COVID-19 jumped off, people made a run on the banks. Think back to 1999 when it was turning to the year 2000 and the end of the world was going to happen because we were going into the year 2000. So people ran to the bank, took all the money out of their bank. That's called a run on the banks. Give me my money now. I'll just keep my cash. It'll be my whoopee and I'll be safe. But the end of the world didn't happen in the year 2000. So now fast forward to COVID-19. People are terrified. I won't get into the numbers, but only 60, now the new projection is 60,000 people. Nationally, out of 380 million people are gonna die. It ain't that serious, but people freaked out. They made a run on the banks. They took all their cash out and the banks were like, yo, we need cash, liquidity. They have to keep 10% of their money for a rainy day. Every dollar that goes into a checking account, for example, the bank, that's a liability to the bank because they know that they got to give that dollar back to, let's say you, Rudy, one day. So they got to do something with that dollar. Years ago, they could lend that dollar out 30, 32 times. Now it's only 13, 15 times. So for every dollar that goes into a banking account, that bank, Wells Fargo, Chase, doesn't matter, they lend it out 13 to 15 times. They charge $19 on an interest rate for a credit card and pay you 1/4% if you give them $5,000 for the next 2 years. That's how they get big buildings downtown. Nevertheless, they had a liquidity issue. People went into the bank, said, give me my cash. Banks have to give that money up. So that caused a great big cash flow crunch on the banks. So with the liquidity issue, the Fed came in and said, dun, 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 we'll save the day, but throwing money at this was never going to solve it. It helped the banks, but didn't help Bob and Betty who own a watch shop in the mall. It only helped the banks. So once again, the banks get the money and the people who need the money don't get the money. Great. So liquidity was the issue. The mortgage companies, like, well, a lot of them, not us, but a lot of them, they then had to continue to make payments on things to the bond investors. So rates went up, rates went down, sometimes by 500 basis points in a day. That's a lot. In perspective, and I know you asked me about brokers, but I got to go out there and bring it all back. A reprice, typically, if bond prices, mortgage-backed securities or treasuries, they go up by 13 basis points in a day, panic alerts go off, rates are going to go up, loan officers, those who are paying attention, know to lock their loans or at least explain this stuff to the borrowers that that's what's going on. Then we had these drastic swings because of the liquidity issues, and we would go up and down by 200 or 300 basis points in a day. That's almost 200, well, let's see, 10 times, 20 times, 20 plus times what normal freaking out would be. People didn't understand this, and so it jacked up the rates. Then the Fed came in, $50 to $70 billion a day, but they were looking for a sweet spot. They weren't going to do it forever. Anybody who thought that was going to go on forever and ever were unaware of reality. So the Fed was always looking for a sweet spot. They have found a sweet spot between 103, 104-ish on the mortgage-backed securities so that things can stabilize. Now they're going to start throwing money at Bob and Betty, $1,200, $1,700. That's not the answer to the problem either. So brokers usually don't know this stuff. People at banks don't usually know this stuff. A lot of people who work for direct lenders, correspondent lenders like KAIROS Home Loans, they don't pay attention to this stuff because they've never had to. So the broker, if they get cut off from Quicken, Quicken is a servicer. They receive the payments on the loans that they fund. Well, when it ain't worth $5 trillion anymore, now it's only worth 200 billion. Those are not real numbers, just an example to make a point. Then Quicken's like, wait a minute, time out. We're not going to fund those loans anymore because we got to regroup and figure out what we're going to do from a cash flow point of view, liquidity.
So Richard,
brokers can't do those.
Yeah. So this is where the question is like, why would Quicken loans have liquidity issue? Like, what caused that problem?
Okay, because when an FHA borrower, any government borrower, FHA, VA, USDA, there is something in the background. So you fund an FHA loan. One of the loan costs is an upfront mortgage insurance premium, and then monthly is MMI, monthly mortgage insurance. Not to be confused with PMI, which is private mortgage insurance. Those are conventional loans, two totally and completely different things. So the upfront MIP, mortgage insurance premium, and the monthly mortgage insurance, MMI, go into this thing called the Mutual Mortgage Insurance Fund. They have two main compartments: forward mortgages, like you have to make a payment every month like FHA, and reverse mortgages, where you can make a payment if you want to, but most people don't. Billions and billions of dollars are in that mutual mortgage insurance fund. When the market went kablooey in 2000 and started in 07, but by 08, we were all enjoying it. They have to keep a 2% reserve. And the people who ran it then, unfortunately, still run it now. I can't do anything about that. I'd love to fire them all. But they have to keep a 2% reserve. They had no idea the disaster that was going to happen from the fallout in the mortgage industry. It was unmitigated risk on the secondary market. People were just buying loans and the sky was never going to fall and people's houses were going to appreciate $50,000 a month. It was cool. 100% financing, stated income, stated assets, no income, no assets, no job. If you fogged up a mirror in 2004 through 6, you got a loan. Well, that caused a big problem. The companies who serviced the loans, to answer your question, they have to pay the investor, the bondholder, the principal and interest payment at least 12 months, up to 18, but they file a claim, the lender, with the Mutual Mortgage Insurance Fund. It's an insurance fund, so it's going to take a while for that money to come back, up to 18 months later. So imagine a company like Quicken right now, they've got to make the principal and interest payment on thousands and thousands of loans. That's a whole bunch of cash leaving their pocket that causes a liquidity issue. So they've got to turn off the faucet, so to speak, because they're bleeding from a cash point of view. The Mutual Mortgage Insurance Fund dropped below 2% in 2008. So they said, well, how are we gonna get that money back? On the backs of the borrowers, they increased the upfront mortgage insurance premium.
Richard, you are saying the reason they have a liquidity issue is because the borrowers are not making the payments. Is that what you're saying?
That's correct. So they're not making the payment. And so they have to make the payment to the investor, the bondholder. And all that money leaves their bank accounts. That's a shortage of money. That's a liquidity issue. So now they're going to hold higher margins on loans unnecessarily.
The borrowers is not making the payments is because a couple of weeks ago, the government, the federal government is telling the homeowners, hey guys, you don't need to pay. There's a forbearance.
Right.
So when the consumers, when the homeowners stop making the mortgage payments, but then the people like Quicken have to continue making the payments. And that's what you are referring to when you say liquidity. So people like Quicken, they say, stop, I'm not going to do this anymore. So therefore, the mortgage brokers, because the mortgage brokers, they get it from people like Quicken. So if Quicken stop it because they have liquidity issue, because they have to continue making the payments and the homeowners stop making the payments, that's the reason why the mortgage brokers are not able to do FHA, for example.
Yes.
Okay.
Okay.
Okay, sorry, I'm just trying to understand this.
Oh, I think that's great. And please, anybody else, if you need clarification on any point that Richard's making, please chime in, because I want to make sure everybody you walk away with clear understanding. For the layman out there, if I'm a buyer, is it a good time to buy right now?
Great time. It's a great time. You make your money on the buy, not the sale. Rates are super duper low. And typically what happens is when the market softens, which is usually a market correction is usually every 5 years and typically 10%. Values come down 10%. This is normal and natural. It has to happen for a lot of reasons. We haven't had a market correction in 12 years. And there's a long reason for that. I can get into it if you want me to, but we're going to have a correction. Typically when values come down, rates go up. And so people don't understand that. It is a direct correlation. So, well, I'm just gonna sit on the fence and I'll buy the $500,000 house for $300,000. It's not gonna soften that much. You're never gonna have that big of a discount on a house. So even if it came down 15, let's get crazy and say 20%. Now I've got a $400,000 house. Yeah, I'm gonna wait for that. Okay, but rates will be 6%, which is still free money. Anything lower than 9% interest rate is free money, but they don't understand that either. And so they end up with a higher payment, even though the sales price is lower. But loan officers don't explain that, rent versus own or total mortgage cost and stuff like that. And so the borrower is left to think that they're going to come up on a great deal, the price is going to go down, and they have no idea that the rate's going to be much higher and they're going to pay more. Congratulations for waiting. It'd be better to buy now with a super duper low rate and be way ahead of that curve.
I'm going to defer to John to just kind of recap that and what Richard just said. I got it, but I just want to make sure we reiterate this point. And I'd love John to recap it. Sorry, John, to put you on the spot.
Yeah, you're assuming that I have that same great understanding. So my understanding is we have clients that are weighing two things, and they don't understand the interplay between the rate that they're paying and the price of the home. So some people think, I'm going to wait because of this catastrophe. The price of the house is going to be less if I wait longer. And what Richard is saying, the cost of borrowing that money is at its lowest rate now. So if you wait, you're going to end up paying more money a month for that same house, even though the price you paid for it may be less. So waiting actually will cost you way more money because the borrower has got to wait they're paying that over 30 years. So they're just adding more cost to that entire price of the loan. So waiting really does cost them hundreds of thousands of dollars more money if instead of getting into the market now and paying a better rate. The cost of money is way cheaper now.
Right.
So if you wait, the cost of money is going to be much more expensive. The price of the house may be less, but what you pay over time is going to be way more. So you're really shooting yourself in the foot by waiting for a better market or a better price.
Right.
Is that right?
Exactly right. Spot on, John.
Yeah.
Great. Thank you.
The psychological, I think the psychological problem with people is price. They get stuck in price, but they don't consider all of these other elements that over time.
Right. Right. The most important thing, that's a great point, Hugo. The most important thing to focus on is payment.
I think that comes.
Payment is the most important thing. Cash is king. Payment is right behind it. So people, well, the other guy quoted me 3%. Okay, I'll go 275. I'll see your 3% and raise you a quarter. It doesn't matter. You haven't found a property. You're not an escrow. We're not locking the rate. So when people say that they want the best rate ever, what do you want your rate to be? 2.5. Okay. You can have whatever you want if you pay for it. So I reach out when stuff happens in the market. I reach out to my network of loan officers, about 300 of them nationally, and I just get blown up with emails. I got to look through them. I was awake when you sent me that email this morning at 3:30 in the morning or something, Christy. But I thought, if I respond to this woman, she's going to know that I'm awake, and I don't feel like getting into emails right now. I was reading through some of those responses. There are a lot of companies who can't do loans below a 640 FHA. We can. We just had a conference call about it today. There are people out there who can't do certain loans anymore. We can. One person said, well, I could do 3.25%. My immediate response was, at what cost? You have to know to ask that question. BB and Lisa know to ask that question. It was at a 2-point cost. Congratulations, I can do it. Lisa priced out a loan at 3.5 this week with a 2-point rebate. That's 4-point swing. So people are full of baloney largely. They don't know what they're doing or talking about. We at KAIROS are really good at what we do, and we're excited to serve your customers. It's the payment, because what if it's an FHA loan or a conventional loan?
Richard, can you explain that? Because I think that's really good, but can you explain it exactly what you mean? So the borrowers, the buyers typically, and in fact, the real estate agents also keep on asking, hey, what's the interest rate? That somebody quote me 2.75, 3%. And what you are saying is, whatever the interest, whatever you want to be, as long as you're willing to pay for it. Can you explain me a little bit more details? Because if I'm the buyers, like, what do you mean? Like, what do you mean exactly? Because I agree with you when you say, well, what's most important is the payments. But nobody ever asked that question. Everybody keep on asking about the interest rate because I don't know, because everybody talk about interest rate. So now you give them the interest rate, but then the payments is all skewed. Can you get more details what you mean when you say that?
Sure. Interest rates only matter if you are talking to, let's say you're shopping, people shop. So what? Okay. So if I talk to, I'm looking at Hugo, Sophie, John, Rudy. So I talk to all 4 of you. You're all 4 different banks right now, and I call all 4 of you, but I call Hugo on Monday, Sophie on Tuesday, John on Wednesday, and Rudy on Thursday. 4 different companies, 4 different days, 4 different rates. The market is so volatile right now that unless you call all 4 companies within 1 hour of the other, you're going to get varying numbers. So if the market improves the way it has in huge swings recently, then I call Hugo, and Hugo says 3.75, 4%, which is a really good rate. But I call Sophie the very next day, and Sophie's at 4.25 because the market got worse. Sometimes within the hour of each day, but I'll use one day at a time right now. Then I called John, and the market got way better because that was the day that the Fed dropped $70 billion into the industry, and John's at 3.5. So I don't pay attention to Hugo and Sophie anymore, even though they might be at 3.25 on the same day. So you've got to know that when you're shopping for a mortgage rate, right now it's so volatile. We've got, BB and I have gone through this. We look at Optimal Blue, our pricing engine. We're at 4.25. Really, we locked a rate for somebody at 3.625. That's the real number. So you have to know that and call and check, and there are other variables in place. But the payment is what matters, because depending on the loan program, if you're FHA, the payment, even though the rate's a little bit lower, the payment might be a little bit higher because of the mortgage insurance premium versus a conventional loan, which might have a slightly higher rate but a lower payment because there's no MMI or PMI or upfront mortgage insurance premium. So it's always payment that you want to focus on. Unfortunately, there are a lot of real estate agents. You're in front of Bob and Betty. There's pressure. You got boots on the ground. You're in front of people on the street, and that's a hard job to have for sure. So they get asked a question. And a lot of people, instead of saying, well, look, let me get you on the phone with my lender, they feel inclined to answer that question on the spot. They shouldn't be answering that question on the spot or at all. And so some of the issues are brought about by real estate agents. I don't talk about real estate contracts. I know enough to be dangerous, but I am not a realtor like John and Hugo and Sophie. These are really good people at what they do. I ask them if I have a question about real estate contracts. If somebody asks a real estate agent about rates, anything financing, the very best thing you can do is to turn it over to me.
So John, what do you mean when you say whatever whatever your rate's going to be, as long as you are willing to pay. What do you mean when you say that?
Name's Richard, but I knew what you meant.
Oh, yeah, sorry.
So that's okay.
That's the day
So,
I call you John. John is on my
all right.
mind.
We'll turn this over to John. John, go for it, bro.
Yeah, Richard, I mean.
So let's imagine. So I want. I'm going to use 4% interest rate. Easy numbers for the Irish guy here. So 4% interest rate. When I go to price that out, there are three options. There's par pricing. That means I'm getting that rate. I don't owe anything. I'm not getting any money back. It's even Steven. 4% at par. It's hardly ever even Steven. It's always going to be a little bit more or a little bit less than 100 on the dot. So if I, in the past, if I raise the interest rate, I'm broke, I don't have enough money for closing costs. Okay, the lender says, I got you. I'll give you a lender credit. Okay, well, they don't really got you if they don't explain that they're charging you a higher interest rate, and which is going to increase the amount of what's called premium pricing or rebate. That money goes to the borrower for their closing costs, but now they're paying 4.25. But now they have $3,000. Okay, as long as the person understands that's what you're doing, cool, do it. Or, no, I don't like 4%. I want 3.75. Okay, then that's 1 point. Typically, if I pay 1 point, that's 1% of the loan amount, I can reduce the interest rate by 1/4%. So $400,000 house, 1 point is $4,000. I want to go from 4% to 3.75. $4,000 will get me from 4% to 3.75 or 1 point cost. So then I say, well, I want to buy it down to 3.5. Cool. Now you're spending $8,000, 2 points cost to get down to 3.5. So the loan officer who popped off at me earlier this week, I know this person, and so I said, at what cost? 2 point cost. So 3.25 at 2 point cost, I could have done that loan at almost no cost because of the position of our company and how we float down and how we use capital markets to our advantage. That's another long story, but that's what I meant. You're either going to pay to lower the rate, or you're going to get money back when the rate goes up higher. Here's one of the wrinkles today. Up until about 6 weeks ago, I could charge a higher interest rate and get thousands and thousands of dollars back to a buyer to help with closing costs. Then it got to a point where a lot of agents here asked me, well, can you pay for appraisals? Nope. I said no right away because I knew that even if I bump up the rate, lenders, investors were not giving a lot of premium pricing because of liquidity, margin calls, hedging, stuff like that. We can get into that if you want to, but the bottom line was that investors weren't giving more just because the rate was higher, because a margin call is this. If I say, okay, John, raise the rate to 4.25. Okay, and I'll give you 2 points back. So now it's not pricing at 100 even, it's pricing at 102.00. Okay, now you've got 2 points, you give it back to the borrower for closing costs. Cool, but rates improve. And now the rate is 3.5. The margin call is the investor, the bondholder, saying, okay, John, congratulations, you now owe me $15,000 to $32,000. Where's my money? Margin call. Well, I've had some liquidity issues, Richard. I can't give you that $15,000 to $32,000. Better go beg, borrow, or steal it. And so margin calls are a major problem. So lenders, instead of saying, okay, we'll give you an extra 2 points, raise the interest rate. No. I don't care what you raise that interest rate to. I could give you an extra $200 or $300. That was about 2 or 3 weeks ago. So we couldn't pay for appraisals. What we have done as a company is we've pooled about $60 million at a time for FHA. And now, as Lisa can attest, she quoted somebody at 3.5% this week with a 2 point rebate, 2 points rebate. That's more than enough to cover a rebate, cover the cost of an appraisal. We're doing the same thing on the conventional side. It's going to be a couple of weeks, but very soon there'll be that rebate pricing on conventional loans as well, so that we can give your buyers the motivation and the incentive to get off the fence. We can pay for far more than an appraisal on an FHA loan right now, and in about 2 weeks, we'll be able to do the same thing on a conventional loan.
Great. Great, thank you. You touched upon it earlier a little bit. You were talking about what other lenders and mortgage companies cannot do, but we can or you can. Can you go through some of those programs that you can offer that aren't out there right now?
Sure. FHA, which is simple enough to do. There are companies who just can't do them. We were on a call earlier today, BB, Lisa, and I, and there are companies out there who can't do an FHA loan below a 680. I'd shoot myself if that were the case. We can still do it down to 580. We went over some of the overlays that we're experiencing, everybody's experiencing. I looked at them and I wanted to do the happy dance. I wouldn't call those overlays. That corporate offices have to mitigate risk. I get that. We can't sell the farm so that we're broke later and out of business. So the corporate office always has to protect home base. Usually that hamstrings a loan originator. What we talked about on today's call, they are really not that scary. I'll go a little bit deeper for a moment and then I'll come back out to other loan programs. On an FHA loan, there's something called the HUD compare ratio. Every loan officer has one, so let's say there are 10 loan officers in a branch. The 10 loan officers create a branch HUD compare ratio or neighborhood watch number, same thing. And then let's say there are 10 branches. Those 10 branches, which are now 100 loan officers, roll up into one corporate HUD compare ratio. The HUD compare ratio is going to directly impact the investor rating from whomever you're selling the loans to. It's a 1 to 5 system. And I always get it mixed up. 1 is good or 5 is good. One of them is really good and the other is really bad. So you don't want to mess with your investor ratings. When you do loans, that's why when loan officers look at 600 to 619, 620 to 639, it's the performance of the loans within each of those windows. And that's why the hits on a loan, the pricing hits, pricing adjustments, loan level pricing adjustments, LLPAs, are more severe the lower the score, because funny thing is when people have lower FICO scores, they don't tend to pay their bills quite as well. That's why they have the lower FICO score. But the person with the 520 FICO score thinks that they should have a 3% rate, and that's just not the same as somebody with a 720 FICO score because they're actually making their payments on time. So FHA would be one of them. There's a lot that goes into this. You can't just quote a rate and a payment because you're a loan monkey. If you are that, you've got to be able to explain that stuff to agents, to borrowers, so that you can actually give value to somebody, and then the agent and the borrower figures out, wow, I haven't heard this from anybody else. I know, it's a problem in my industry. Another issue would be non-QM. So non-QM is a non-qualified mortgage. That's what QM stands for. The market went kablooey. The qualified mortgage came out, and the back end, the debt to income ratio was set at 43%. Couldn't get a loan done. So everybody ran to FHA because FHA could go up to 54.99. VA could go up to 65. That's ridiculous to fund that loan, but okay, that's what companies were doing. Then the government came in and put a Band-Aid on the qualified mortgage, called it a QM patch. It expired years ago. We've been on extensions for years. Think paddles, put them on the heart, clear, keeps people going. That's what the QM patch has done, and people on the conventional side have been able to do loans up to a 50% debt to income ratio. When that goes away, people better know how to do FHA, and they better be able to do non-QM, and if they can't, they're going to be out of business really quickly, unless you work for Wells Fargo, B of A, etc. Non-QM right now, bank statement program, stated income, foreign nationals, debt service, no ratio. These are non-QM loans that a lot of people at this, Lisa knows all about this. Lisa worked at this. They shut their doors. They're not even doing business anymore, and they were the #1 non-QM company in the country. So a lot of those people, the non-QM companies are not backed by Fannie and Freddie. So their rates on the plus side, the positive side, their rates don't fluctuate quite as much as a regular loan, FHA conventional loan would. But on the bad side, they ain't got the backing of Big Brother, Fannie and Freddie. And so when things shifted, a lot of those companies went out of business. Thankfully, so Citadel, they haven't shut their doors, but they're not doing any business. Impact, huge company, not doing any business. Athos closed their doors. So I brought in 2 companies that I'm aware of who were still doing non-QM, got them through legal and compliance. We still can do non-QM loans. A lot of people are just out of luck on those. Stated income, gone, can't do them. Nobody can do those. So stated income as we know it is gone. Also ITIN programs, gone, can't do them. But foreign national, bank statements, debt service coverage, no ratio, we can still do those non-QM loans. We just have to make sure we're matching them up correctly. Those would be the 2 biggest deals, FHA and non-QM, we can still do.
What about down payment assistance programs or first-time homebuyer grants? Do you have those available?
We can, thank you. Yes, those are available. So if it's a city program, City of Long Beach, City of Compton, we're not doing any city programs for a lot of reasons, not the least of which is they're such a pain in the butt, miserable deal to do. If you can close those in 60 days, you're lucky. So we're not touching those. But the state of California has a program called Cal HFA, California Housing Finance Agency, I believe is what it stands for. And we can do those. We can also do a federal grant called Chenoa. So we do that directly, Cal HFA, we broker, but we can still get the loans done. They're going to close between 30 and 45 days, not because we're slow, but because we're subject to government agencies who are not known for moving very quickly.
Okay, great. I'm going to open it up to, is there any other questions on various programs or different programs that Richard can offer, see if he can offer them that I haven't covered so far or he hasn't covered?
I have a question, please, to Richard. Richard, thank you for, as always, for the wealth of information. Can you please speak to the requirements and the offerings available through the debt service coverage ratio program you just mentioned?
Sure. Debt service coverage ratio. So that's going to go down as an investment property. Even though we know Bob and Betty are going to live there, we got to call it an investment property because it's a non-QM loan. So that's going to be 25% down payment, and you have to have a minimum, well, 40% down payment if you have a 620 FICO score. So if anybody just says, here are my bank statements, tell me if I could buy a house, we still got to run the credit. So you could go up to, it's 40% down to a 620 FICO score. If you have a 640 or higher, you can do 25% down. Here's what we do. And please don't use Zillow for anything when it comes to valuation of a house or rents.
Mm-hmm.
Go to Rentometer. Use a real website because Zillow's usually wrong. Actually, they're almost always wrong. So 80%, let's say it's a $500,000 house, and let's just say that the rent is $4,000 a month. Here's how the debt coverage ratio program works, Sophie. I take the fair market rent, and it can't be inflated. By the way, this is all going to have to be backed up in an appraisal. So if the appraiser doesn't say that $4,000 rents are what the market rents are, then we got an issue and we got to go back and forth. I have no problem battling underwriters. I have no problem arguing with with appraisers. If you're messing with my deal, then I'm just not very friendly about it. Anyway, the debt service coverage ratio, DCR, debt coverage ratio. I take 80% of the rent. If the PITI, so we used a $500,000 house, $4,000 a month for rent, 80% of that is $3,200. The PITI, the principal, interest, taxes, and insurance, homeowner's insurance on that house has to be covered by the $3,200. So you're not even using somebody's income for it. You're using 80% of the fair market rent. And if that amount covers the PITI of the subject property, you got yourself a deal. But you got to have reserves. So if the payment, let's just say that the payment is $3,200 and 80% of the market rent's $3,200, you got yourself a deal. $3,200 is your monthly payment. If you're buying a house up to $1 million, the loan amount, not the sales price, the loan amount, then you have to have 3 months of reserves. So it's 25% down, assuming you have a 640 score or higher, 25% down payment. That's a lot of money. Then you've got a $3,200 a month mortgage payment times 3. That money's just got to be sitting somewhere in a bank account collecting dust. They don't have to spend it. It's never going to leave their account, but it's got to be there as reserves. So there's down payment, closing costs, and reserves on every single deal.
Two questions. Thank you very much. Very, very helpful. 2 questions to that. Can you repeat again the name of that website? Rent? I didn't get that.
Rentometer.
Rent?
Rentometer.
Rent-O-meter. Okay.
If you
And
go to,
also,
go ahead.
and also, do HOA fees come in with that valuation?
HOA fees, although they're paid directly to the HOA, it would be included in your PITI/HOA. So good point. Thank you, Sophie. If it's a condo or a PUD, some people think, well, it's a house. No, it isn't. Look at the property profile. If the legal description is a PUD and it's $60 a month because somebody is going to come and mow the lawn around the mailbox and that's all that they do for you for $60 a month, it's a PUD, a planned urban development, and you have to include the HOA.
Great.
So I have one question on our list, and then I'm going to open it up to all the attendees. How do you see the forbearance hitting current homeowners when it comes to their mortgages?
It's gonna cause a lot of problems because of the bad information out there. Forbearance, if it's truly a forbearance, that means that I'm taking money, let's say the $3,000 a month that my mortgage payment is, and I'm putting it on the back of the loan. But a lot of mortgage companies are giving deferments. That just means that I'm not paying it we're in April. So I didn't make my April payment. On May 1st, I'm going to owe 2 months. On June 1st, I'm going to owe 3 months. So after the 3 months is up, July 1st comes around, I now owe 4 months of mortgage payments. That's a deferment. That's what most lenders are giving, but everybody thinks, oh, cool. I don't have to make my mortgage payment for 3 months and I'll just pay it at the end. Only if they were approved for a forbearance. And people are going to, renters, they're going to get caught. Mortgage people, they're going to get caught. People who owe a mortgage or rent every month. If it's a deferment, man, you better come up on a lottery ticket, or you're going to have 4 months of payments that are going to be due. And then when the government opens up either evictions or foreclosures, you're going to get kicked out your house.
So that is a great explanation of deferment. Can you kind of do the same for the forbearance, or is it going to operate the same way?
A forbearance, one, you got to call. If you can't make your payment, you can't make your payment. If you can make your payment, make your payment. If it's a forbearance, the $3,000 a month that I would pay for April is going to be put, let's say I just took out the loan and 30 years from now is going to be the year 2050. So I'd owe that month or up to 3 months in the year 2050. I don't owe it now. It's not building up, and now I owe 4 months in July. I'll owe those 3 extra months. Now, instead of making 360 payments, I'll make 363 payments.
Okay, awesome. I'm going to call on John again to recap that, the difference between the two.
Well, I think he made a good point. It's people get confused. You're deferring the payment. So you got to think of the actual meaning of the word that you're using between forbear and defer. So a deferment, and if they start using those words interchangeably, the public does, the consumer, that's where the problem really lies, because they think, great, I haven't had to make that payment, but the clock hasn't stopped. So it's like they put it on pause, but it keeps accruing. So when it accrues, it's like, think of those credit cards when they say no payments for 6 months, but the payment actually accrues. And if you haven't made those payments for 6 months, at the end of 6 months, wham, you're hit with that whole payment schedule. So you haven't lost anything. So that's deferment. Forbearance is you're forbearing the payment, and as Richard says, it goes to the back of the line. So you're not having to pay April, May, and June, and then you can pick up your payment in July. Well, when are those payments going to be due? They're going to be due at the end of that loan. So 28 years later, 29 years later, at the end of that payment. So you want to talk to your loan servicer. So as Richard says, if you're having financial trouble now because of this COVID-19 and you can't make your payment, you want to have that conversation now. Talk to your loan servicer, not the loan officer, the person who's servicing that loan, and you want to ask for that forbearance, not a deferment, because now you know the difference. Because one will just accrue and you will actually be in more pain because you haven't been working. And so you don't have more money at the end of that deferment period to now make up those joint payments,
Right.
like you would a forbearance. So that's a real difference because it's squeezing those homeowners. They think, I'm just relieved I don't have to make that payment now. But the payment obligation doesn't go away in either case, but the deferment, that obligation hits as soon as the clock starts again. And people are going to be in real trouble because they have not been saving that money because they haven't been able to make the payment. So that's the big difference for that.
Right.
Great. Thank you, John, for the recap. Sophie has another question. I'm going to defer to her and let her ask.
Right. Thank you, John, for translating. Richard, my question is, with either program, the deferment or the forbearance, is there additional interest rate on top of those? If so, does the loan get recalculated? How does that work?
No, good question, Sophie. No, there's no additional, there are no penalties. If somebody qualifies for the forbearance, no penalties, no late payments, nothing is charged to the borrower. Whatever the payment was is, and let's say it goes a full 3 months, they just throw those 3 months on the back of the loan and they pay it later. But there are no penalties. The better strategy for people is to do a cash out refinance. Why? So that way I take some of the equity, I make the payments while I can, I don't owe any money later. And now when I have a personal liquidity issue, potentially, I've got the money to make all my payments, even though I'm not working, not getting any money.
Richard,
Hey, Richard, I'm sorry. I got one more quick question. And maybe you're going to ask this, Christy. So at this time, and this is for buyers, what would you like the buying public to know, or even the agents out there, because they're confused? As you said, there's lots of misinformation or incomplete information. What would you want the buyers to know now if they are thinking, I've been saving? What are the good questions they should be asking? Is it the rate? Is it how much down payment? What matters more now if they're getting into the market and they want to buy? What kind of a down payment do they need? Or what do you wish they would know, to a basic question to ask in this environment?
Good question. That is multifaceted. And here's what I mean, John. The good thing about looking for a house right now, if you're looking to buy a house, don't wait. There are a lot less people out there buying houses right now. So your competition is much lower. Strike while the iron is hot. Two, understand that it's better to cough up all of the paperwork in advance so that when you write the offer, you're not given bad news a week later. Oh, I know you like the house, but you can't buy it because I didn't see your tax returns. I saw a pay stub and a W-2, made a snap decision. Here you go. And now you can't buy the house that you already had begun to think where the couch is going to go. So giving up the information in advance is very important. Knowing that you should be out looking for a house now because there's far fewer people looking for a house right now. Also a good idea. It's always about payment, not rate. Yeah, rate is but it's secondary. What's the payment? Because if I look at people's information, BB does this, Lisa does this,
all right.
They're going to look at what loan program do they qualify for. We want to provide loan solutions. So here's what it looks like conventional. Here's what it looks like FHA. Here's what it looks like fill in the blank. And the rates might be different, probably are. In fact, almost certainly will be, but the payment, even though it's a higher rate, might have a lower payment. So you got to focus on payment and not think rate. People read articles and think that, well, I read an article, or I used to be a loan officer. When? It was 2006. It's not the same anymore. Don't say that you're a loan officer. Or my cousin, aunt, uncle, Indian chief, somebody who was my barber is a loan officer on the side. You got to talk to somebody who knows what they're talking about, please.
Okay, great. A couple more questions came in on the investment side. Do borrowers have to own their primary home to qualify for an investment loan? And for investors, what does that look like for them right now?
No to the first question. If they're going non-QM, let's say the debt coverage ratio program or no ratio, we're going to call it an investment program, even though they don't own a home, and the house that we're calling an investment is really going to be their primary residence. That's the only way to get that loan done, is to call it an investment property. So no, they don't already have to own a home. They could buy now. We know that they're going to live there, but we're going to call it an investment program, and they're going to put 25% down. Go. What was the other question?
Is it looking good for investors right now in terms of interest rates and what's required for them?
For sure. If a property cash flows, so there are two different types of investments typically. I'm going to buy it, I'm going to hold it by renting it out. If it cash flows, it cash flows. If I buy a house and I'm going to fix it up and sell it, that's a flipper. Then they better really know what they're doing with numbers. Either way, you got to know what you're doing with numbers. But if I buy a house today and I think I'm going to sell it inside of 90 days, I have all sorts of problems with Bob and Betty who are going to buy that house because I'm inside of 91 days. There are rules for loans done between 0 and 90 and then 91 to 180. So you have to calculate that with your cost of the use of money that you're going to use for a flipper. So a flipper, yes. If you do it the right way and you do the numbers, or calculate the numbers properly. If you're buy and hold, either way, it's a yes, because here's what happens when markets adjust. Rents don't go up a little bit, rents go up a lot. So if you buy a house now and maybe you're just breaking even, maybe making $100 a month, that's still a good deal, believe it or not, because you got to think long term, just like buying a stock. It's 30 years from now, not 3 weeks from now. So when the market adjusts, and it's going to adjust, my prediction for the last couple of years was the third quarter of this year. We'll see if I'm right or not. When that happens, rents are going to go way up, which means they'll cash flow even more. People who think, oh, I'm going to wait and continue to rent, it's financial suicide to do that, because when you buy a house, the payment stays the same. Nobody can kick you out. If gentrification does happen, you're going to come up on a lot of extra money. Cool, good for you. But if you're renting, you're going to get kicked out. You're going to get 30 days notice, maybe 60 if you're lucky, and your rent's going to go way up. Now where are you going to live? Now you can't live in West Hollywood or West LA or South Bay or somewhere where it's nice. Now you got to drive on the 91 out from Fontana. Congratulations for waiting. You just shot yourself in the foot.
Okay.
Hey, Richard, one more question. Is there a debt to income ratio that a buyer has to meet for that debt coverage service loan?
I think there's always, it's 50%. Lisa, chime in here. I think it's 50%. Is that true, Lisa?
I'm pulling up the guideline worksheet, so give me one moment.
Okay, I think it's 50%. It depends on the program, but generally speaking, 50%, John.
All right, and you had also said as long as 80% of the market rent covers the PITI, that loan is probably going to be good?
It will be good.
Okay.
That's how the program works.
Oh, Richard.
Got to make sure that the rent is accurate.
Yeah, Richard, I guess my question is, when we go with conventional, we know the DTI is 50%, right? But I was talking about the debt coverage service that you mentioned earlier.
Yep.
I don't think it makes sense 50%, because like your rent, if you can cover 50% of the expenses, I don't think they're gonna take it. I just want to make sure, like,
Okay.
is it a
You're not the investor, so that's good news right there. If 80% of the rent covers the PITI, you got a deal. There's no real DTI.
Then it's not 50%, because your income literally cover whole PITI. That's like 100%.
The 80% of the rent would cover the PITI. You got yourself a deal on the debt coverage ratio.
Okay.
Generally speaking, non-QM is 50%. That's all I meant.
Okay. So
Okay.
It's not like commercial. You have to like be 1.25 above of your PITI.
Deal. Apples and oranges, correct. And by the way, you made a comment, Wesley, very important. A lot of people think that, well, it's 50% on a conventional deal. Not necessarily. With the way the market is right now, let's say somebody has a 670 FICO score versus somebody with a 740 FICO score. The The 740 can probably go up to 50%, but the 670 person might only be able to go to 45.
Yeah, we got that part. Ideally, we are talking about any person with FICO about 740, 80/20 LTV, and then good income ratio. That's what we're talking about. But then that's the ideal general guideline, right? But for the debt coverage service, so let's say your 80% rent cover all PITI. The investor doesn't require extra. Like
Reserve.
let's say your PITI is 3,000, and then your rent is 3,000. That's even money. That's not
Right.
extra ratio on top of it. Would they be okay? I guess that's my question.
The only thing on top of that, if we're only talking about the debt coverage ratio program, Wesley, then
Yes.
the 80% of market rates cover the PITI. You got a deal. The caveat, the but, is that you still have to have reserves.
Yeah.
So they put a big down payment, 25%. They also have to have at least 3 months of reserves of whatever the PITI is. If it's $3,000, they got to have
9,000. Yeah. I mean, that's you got to close the gap already. And that's they can, like Rudy said, when they need the money, they always can come up with something. 9,000 at the end is pretty close. But we just want to know the guideline, like if as long as the PITI was met, there's no extra. You have to go above PITI like 20%. No, as long as it's met within PITI, you're good.
Correct. But to your point, Wesley, you can't just say, oh, here, I've got an extra $20,000. I had that in my bedroom closet safe, and I'm going to put it in my bank account tomorrow. And now there's a big $20,000 cash deposit on somebody's bank statement.
Mm-hmm.
Now you're stuck. So that's nice that you had that 20 grand in your closet safe. But let's figure out a way so that we call that a gift and we do it the right way so that you can get your deal done.
For the investment home, we cannot take gift, right? The money has to be seasoned. But then for this debt coverage service,
anybody, you made a general statement, so I responded to the general statement. Anybody who's got the money, because they can find the money and they go put that money in their bank account, and now we've got a great big cash deposit showing up, that's going to kill a deal.
Not a cash deposit. Let's say, even though your dad write a check for you for investment home, you still cannot take the money, right?
How's that deposit going to show up on a bank statement, Wesley?
It's just a check.
It's going to show up as a cash deposit, dude.
Uh-huh.
Non-payroll, non-ACH is a cash deposit. I don't care if it's the dad writing a check, you've had cash in your closet, Aunt Peggy gave it to you, doesn't matter. That's a cash deposit. It's a non-payroll. Anything non-payroll, non-ACH is a cash deposit. And you got to be able to explain it. If it was just cash laying around, you're not going to get credit for that. If you say, well, I sold my car. Okay, where's the bill of sale? Where's the proof? Where's the canceled check? Everything has to be proved, especially now.
Is that 2 months seasoned? Is that what it is?
Are we still talking about the debt coverage ratio program?
Oh, sorry. No, sorry. On the all of a sudden a little cash came in, that has to be seasoned for 2 months. I shouldn't say a little, like if it's a big chunk.
Anything that's non-payroll, non-ACH, it has to look like it was in your account. So if somebody came up on 50 grand, their Uncle Joe is going to give it to them. However they got it, and they put it in their account today, April the 10th. Then the only purpose for waiting, because they can't prove it, it was cash, great, you know it, I know it, great. Then they got to wait until June the 11th, or 2 bank statement cycles, depending on when so if it shows up on their April 30th, and that's the end of their bank statement cycle, then you got to wait until the end of June, so it looks like that money was there the whole time. That would be the only reason to wait.
Richard, on that scenario, I actually have some clients in this scenario right now. And on that note, do all of these assets need to show on the borrower's own bank accounts, or can it be the gifters?
Yep.
It does.
Yep. You can use gift money on an FHA loan.
Mm-hmm.
You can use gift money on a conventional loan. Those are qualified mortgages. On non-QM, debt coverage ratio, bank statements, no ratio, foreign national, that money's got to be in the person's account. No gifts.
So in that scenario, let's say there's a gifter, we can add the borrower onto the gifter's bank account, correct or no?
No, all that stuff is old school. It doesn't work anymore. You can't just add somebody to a credit card that's going to show up as an authorized user. They're going to have to they're going to have to get that off of their credit report. If you all of a sudden show up on somebody's bank statement and you're not married, underwriters look at stuff like, why should I give you $1, let alone $500,000? And all of that stuff has to be explained.
Or unless the gifter is also a borrower and untitled.
Okay, so
Then he's not gifter no more. If it's untitled, he's the applicant. So,
I'm asking because I'm trying to see if there's a solution and not just say we don't service your loan. That's the only reason.
there are people who think it's 2006. It ain't. I'm not saying that's you, Sophie. I'm saying people come to us and they think it's 2006, where I could just add myself to 3 people's credit cards. It ain't like that anymore. It hasn't been like that for a long, long time. We've had people recently come to us and they didn't come, they're self-employed and they haven't completed their 2019 tax returns. And they say, well, can you help me figure out what to put on my tax returns? No, that's mortgage fraud. I'm not a CPA. I'm not going to tell you how to prepare your taxes so that you can qualify for the home loan. That's mortgage fraud. Can't do that. So people who, well, I'll just add myself to this person's bank account, or I'll just go ahead. Please go to the other lender, because we're not going to have fraud on our books. It's the fastest way for the FBI to come in, take that stuff really seriously. And I don't want to go to jail. I love my son.
Okay, Richard, thank you so much. I know we could go on for another hour or more because we have personal stories. We also have clients that we're working with personal interests. So before I close this, Lisa, I think you were going to look something up. To provide some information, or are you good?
So the debt ratio factor was 0.80. In previous companies, I have seen the debt ratio be much, much higher, 1.1. And so there is a spreadsheet in which we use to calculate many aspects of the loan. And so I think Richard, Bibi, and I encourage you to provide us with as much information about the borrower, the property, so that we can import this stuff into our spreadsheets and get an idea up front so that we know, A, what we're guiding the client to know, making sure we're transparent, knowing that what we're working with are guidelines that are provided to us, so that we can factor those numbers in and say, okay, your max capacity of purchase is $1 million based on these factors, and zeroing in on that. Are we going to see changes? Yes, we're going to see some changes. Lenders are going to go ahead and tweak their guidelines, their ratios a bit as to what their risk level is. So what we say today may be different on Monday. So it's important that you, your client, the realtors, everybody's as transparent as possible with as many details up front, because then we feel we're on the same plateau together and not, peaks and valleys of like, oh, it was this on Friday, it's this today. So knowing that information is helpful so that we can utilize the tools that we've been given from each lender, each investor, underwriters, and our back-end team, so that we can help you guys cater that purchase price, that RPA and everything, and get that out there with minimal surprises.
Awesome. Well, Richard, Lisa, and Bibi, all those representing KAIROS Home Loan on this Zoom meeting today, I want to thank you for your time. This has been extremely beneficial. I know we could go on for hours. There's so much to gain, so much knowledge that you guys can share with us. It's going to be beneficial for our clients. So maybe we'll have to do a part 2. But for right now, we're going to go ahead and close this out. Thank you, everyone, for attending. You have one more thing to say. Go ahead.
Only because there were 2 terms used and they're the same exact thing. Wesley's question was DTI, debt to income ratio. Lisa said 0.8 DTI. They're the same thing. 80% of the, if we're talking about the debt coverage ratio program, 80% of the market rates, that 0.8 or 80% is the DTI. So they're not 2 different things. If the market rents cover 80% of the market rents cover the PITI of the subject property, you got yourself a deal.
Oh, go ahead, Rudy.
Sorry, last question. So Richard, two things. Number one, what is the best number to call you if we have more questions? That's number one. Number two, can you end the call by explaining what is the difference between what is a pre-qualification, a pre-approval, a DU underwriter's approval, and what does it mean for me if I'm the buyers in today's market? Like, because everybody are throwing this terminology, and like, what's the outcome that we want to accomplish? Because in our team here at Your Home Sold Guaranteed Realty, we want to make sure for our clients, our buyers' clients, when we submit an offer, their offer is clean, meaning it's full. Meaning the loan has already been approved. So, but can you explain what it means in details to, what is all this terminology, pre-qualification, pre-approval, and DU underwriter's approval?
Sure. Pre-qualification simply is somebody tells me how much they have, how much they earn, and what their credit score is. That's a pre-qualification. It's subject to the verification of everything. So if you get a pre-qual letter, and that's what a lot of people use as a slang term, a lingo, an industry term, pre-qual letter, if it's really pre-qualification, it's only the borrower or prospective borrower telling us information. That ain't gonna get you very far. Pre-approval letter would mean that we've looked at the tax returns, pay stubs, and the reason we look at all of that stuff, not just a W-2 and a bank statement, I'm sorry, a W-2 and a tax return, is because a real pre-approval, you've looked at the tax returns. A W-2 is nice to have, but when you really dig into the tax returns, you see that somebody really has a side business, a Schedule C, they're a sole proprietor, and they wrote off everything, and that's a negative number. Well, that's going to reduce their income, and so if you use only a W-2, you could have a bad surprise in a week or two when you get into underwriting. So pre-qual, I'm just telling you. Pre-approval, I'm showing you. And if let's look at the VIP buyer agreement. Some people say, well, he's a VIP buyer. Only if they've given us all of their information are they a VIP buyer. Otherwise, they've just signed a piece of paper. We want to provide service. Number one on the VIP buyer agreement is pre-approval, which means you've given me the information, and a loan approval certificate. That's not a full underwriter's approval. That's a DU, desktop underwriter. It's an automated system. Garbage in, garbage out. So if I only have a pay stub and a W-2 and I bang that into the system and I get an approval, it might not be really that accurate because I just put in there whatever I want to put in there to get an approval. But when I put accurate, totally detailed information into that and I get the loan approval certificate, which is the DU findings, now you're offered, now you can hang your hat on it. Now you can close that loan knowing that somebody's got a loan. So it's really important to, one, turn the buyers over to us. We're good at what we do. Number two, make sure they send everything to us. If they're concerned about their score going down, the privacy of their information, hand them over. We will walk them through that and get their information. Otherwise, if they don't want to send it, they're not a VIP buyer, even if they signed a piece of paper, because they're unwilling to give us the information we need to fulfill that agreement. And we want to fulfill the agreement.
Okay, awesome. Again, thank you so much, Richard, Lisa, and Bibi with KAIROS Home Loans. Richard, how do we, can you share your information so that if somebody needs to contact you, they can do that? Or how do they reach you? What's the best way?
My email address, which is the best way right now, is rmurphy, M-U-R-P-H-Y, rmurphy at KAIROS, K-A-I-R-O-S, home loans, plural. rmurphy at kairoshomeloans.com. You can call me or text me at 323-842-5848. That is my cell phone number. So if you call me and it takes more than 5 minutes for me to call you back or text you back, please know there's a reason for that. Email, I'm way better at responding to. Text messages, we've got more loan officers coming in. We're growing. Turn times are going to get even better, but that would be the best way to find me. Internally, if there's an issue or a question, please just email me, because somebody emailed other people within the company in leadership this week, and when it all came out about an hour or two later, we were 24 hours ahead of schedule. So there was no reason to send off that email. We were responding within 48 hours instead of 72. So just let me know if you have a question. We'll take care of it. I promise.
Awesome. Again, thank you so much. Thank you everybody for attending, and this concludes our meeting.